Hello, this is Matt Halloran for Debit This, Credit That, joined by Matt Wheeler, managing partner of Wheeler Accounting and a CPA. Now, today we're discussing lifestyle deductions when it comes to vacation home tax breaks. So if you have a vacation home, this is really going to resonate with you. And Matt's going to take some time today to discuss all of the different things that you need to take into consideration. So Matt, thanks for joining us today. And let's dive right in with what is the big problem that people end up having with these vacation homes?
The problem really is that people are unaware of all the substantial tax breaks available to them. When they have a second home, people are generally aware of the usual tax breaks. You can deduct the property taxes. A lot of times you can deduct the mortgage interest, but there's a whole other slew of tax breaks available if you plan properly and structure it right. So it's really about awareness, I think, and knowing, with proper positioning and planning what you can do with your second home to really, kick up your tax savings to the next level.
So does this just affect people with second homes that they're living in? Does this affect people who have rental second homes, multiple second homes, third homes, fourth homes? Who does this affect?
It's going to affect anybody who has more than one home, and these rules aren't going to apply to your primary residence. But if you have a second home, especially if it's in an attractive, vacation rental type market, in our area, you might think of something like Lake Tahoe or the wine country, something like that. Or even, third or fourth homes, these rules are gonna be available to those people.
Okay. And when I'm thinking about if these apply to me specifically, what questions do I need to ask myself?
You have to ask yourself, number one, do you want to consider renting your second home out, right? If you use it personally all the time, these rules aren't going to work for you, right? It has to be something where you're considering renting it out to, supplement your income or help offset some of the operating costs. You need to ask yourself, how often are you going to use it personally? If you have a really high level of personal use, the rules may still apply to you, but they're not going to be as advantageous. But we usually find most people, when they have a second home, don't end up using it as often as they would like. So I think a lot of people do fall into this category. And then, lastly, I'd ask myself if I really have the time and energy to devote to renting it out and maintaining some of the books and records that are required to take advantage of these rules. It's not a huge amount of time, but there is some time and legwork involved to position yourself. So in case you do get an audit on this from the IRS, that you're well positioned to defend your deductions.
Are there any tools that are helpful when it comes to maintaining these books and proper records that you recommend to your clients?
Most of my clients probably just use, Excel or whatever kind of general system they have. I mean, it's not hard to maintain the records. You just need to know the rules, right? And make sure that you're keeping track of the proper things. And we'll get into that a little later.
Okay,
what
awesome.
are the specific rules you need to worry about, that kind of thing.
Well, so why is this important? I mean, is this a huge benefit to people? Is this something that they can use to cover their butts? Help me with that.
It can be hugely important and really beneficial. I mean, generally, as we know, we talked about it before in a couple of other podcasts, that the tax rules really favored real estate, right? And, the usual deductions available to real estate, people just think of property taxes and mortgage interest. But when you convert your home into a rental home or a vacation rental, which is the stuff we're going to talk about today, there's a lot of other things you can deduct. And then if you structure it right with the rules and follow the rules precisely, you can actually take those deductions and offset against your other active income and really save on current taxes every single year a significant amount. And I have, a few clients that have done this where they have a second home. Lake Tahoe is a good example for the Bay Area here, where they have a home in Lake Tahoe. They bought it with the intention of using it a couple of weeks a year or whatnot each year for personally, but they also don't mind renting it out to help offset the cost of ownership. And they have an eye towards in the future probably retiring up in Lake Tahoe or something like that and living in the home. But in the meantime, renting it out, they can offset the cost of ownership. And when we follow the rules right, they can even use those tax losses that it generates against their current W-2 income or investment income and really save on taxes over the years.
Well, let's jump into the rules. So you've got 4 different rules here. What are they, and let's break them down.
I like to break it down into a couple of categories. There's the standard, real estate rules that apply to anyone that owns a second home. There's the specific rules related to rentals, and there's a differentiation between long-term rentals and then short-term rentals, which is going to be the focus of what we're talking about here. There's rules around personal use of the vacation home, and then there's rules around the books and records you need to defend yourself in an audit.
All right, well, let's talk about the second resident rules. Standard second residence rules is what you have listed here. So what are those?
Like I mentioned already, there's a couple standard deductions available to each person when they own a real estate. The number one is property taxes. You can always deduct the property taxes on as many different pieces of real estate as you own and use personally. So you could have 15 extra homes above your personal residence. You can deduct the property taxes on every single one of them, right? Also, mortgage interest is generally deductible on a second home. You have some limitations there. You can only have $1.1 million of debt on your combined primary and second residence. So if you go over that limitation, you're not going to get the interest deduction on that extra debt. If you have a third residence that you have debt on, you don't get to deduct that interest. But you do get to deduct the interest on your second home. So a lot of taxpayers fall under that rule.
Now,
they get the interest in taxes.
Is that federal or is that state? How does that break down?
It's a federal rule,
okay.
And most states, I believe, conform.
Okay, good. Okay, I'm sorry. Sorry to interrupt there. I just wanted to know if that was something in the – I mean, because you were already talking about Tahoe. So you're talking about, people potentially, and one of the things that we talk about is if it's in the same state. So I just wanted to ask that question. All right, so
Sure.
Let's keep going with the standard second residence rules.
I mean, those are the two major ones. All the rest of the expenses you have for your standard second residence, insurance, utilities, homeowners dues, maintenance, repairs, that kind of stuff, you don't get any current deduction for that kind of stuff. It's all considered personal expenses. The tax code doesn't allow you to have deductions for personal expenses. Major improvements, they will add to your tax basis in the home. So if you do a big remodel, add on a, extra room or something like that, that's going to add to your tax basis. But that's a long-term thing that you're going to recoup when you sell the property.
Sure. So I've decided that I want to rent this place in Tahoe, and we'll use that as the example today. What's the difference here? What sort of stuff are my benefits if I would feel comfortable renting it out?
Well, once you get into the realm where you're renting out a piece of real estate, at that point you already unlock a slew of extra deductions that you can take against the income, right? So you have to declare all your rental income, generally speaking, but now you can deduct all those operating expenses against the rental income. So utilities, insurance, homeowners dues, the maintenance, all that kind of stuff. Those are all deductible against the income on the rental, right? You can also depreciate the home. That's a non-cash deduction. Basically, you're deducting the cost of the home over a period of time to kind of recoup your purchase price into the home. So for a standard piece of rental real estate, we deduct the depreciable basis over 27 and a half years. So it's a long-term deduction, but it's something where you're not spending money out of pocket, but you do get a deduction every year. Those are the general rules for any rental where you get those deductions, but the key is really what type of rental do you have? And there's two major types in the tax code. There's traditional long-term rentals, where you're renting it out to a long-term renter on an annual basis or even for several months, that kind of thing. And then there's short-term rentals. In the tax code, we have what's called the passive activity loss rules, and these basically limit your deductible expenses in the current year to your net income from the property. This is going to apply to the long-term rentals. So if you have $20,000 of rental income, but $30,000 of rental expenses, you have a $10,000 net tax loss on the property for the year. If it's a passive property, you can only use that $10,000 loss against net rental income from other properties or other passive activities, or what usually happens is that loss accumulates kind of into a bucket, I like to think, and that carries forward to future years when you either have other net passive income that you can dip into the bucket and use those losses against, or when you sell that piece of property, you can then take those losses all at once.
Okay. So that's long-term rentals, and you said that's monthly or longer. What's going on different? So Tahoe's, again, is a great example because some people are going to stay there in the summer and some people are going to ski in the winter, and the average period use is probably going to be 7 days a week or less. So how does that change this whole scenario?
So 7 days or less is a key rule. When the tax code says that all rentals are automatically considered to be passive activities. So when you have a rental, you're stuck under these passive activity rules, which can be limiting on your current losses. But there are a few exceptions. There's 6, in fact, to where you escape that automatic passive treatment due to just being a rental. The exceptions are really designed to exclude activities like hotels, bed and breakfast, or, a golf course, something that has like minor rental operations that are kind of incidental to the business, like maybe they occasionally rent small equipment, that kind of thing. But the rules apply to anything. And one of the specific rules that we usually qualify under for the vacation homes is if the average period of use by your renters is 7 days or less. So if you rent to, 10 different groups during the year and you rented a total of 69 days, then you have 6.9 days as your average periods of use per rental group, right? So you're under that 7 days or less. You can have one group rent it for 2 weeks as long as all the rest of the groups rent less than a week to where you get the average under 7 days.
Interesting. Okay. Now, do you have to document this? You were talking about your books earlier, but this would be proven by contracts, I'm assuming. Is that how you find out and are able to calculate that average?
Yeah, this is one of those bright line black or white tests in the code. 7 days or less has to be under 7, and it applies on an annual basis. You can meet the test in 1 year, but then not meet it the next year, and your rental will flip-flop between being a passive activity automatically and not being a passive activity by virtue of these rules, whether or not you meet the 7 days or less, rule on an annual basis. So good books and records are key. Rental contracts or anything you have that kind of documents how long the rental periods were for, who the rental parties were, that kind of stuff to make sure you meet this average of 7 days or less.
All right. So what are the other benefits? You said that there was a number of different things here. What else do we need to know about these short-term rentals? You say that there's a major tax break, but break that down just a little bit more if you wouldn't mind.
So you got to meet 2 hurdles to get the major tax break. Okay. The first one is the 7 days or less. If you meet that hurdle, you're out of the automatic passive treatment due to being a rental. So we passed the first test. The second test is that you need to materially participate in the activity. And this is another section where the code's very technical and precise. There's 7 ways that you can meet the material participation tests. Generally, though, for these vacation home rentals, the first 2 are really where we see clients meet the test. 1, you got to spend 500 hours per year on that activity. That's a pretty high threshold and pretty difficult to reach for a single vacation home. So the second test is if you spend more than 100 hours a year on the activity, and it's more than any other single individual. That's going to include, the gardener, the maintenance guy, the maid, anybody involved in the activity. You have to spend at least 100 hours and then more than any individual one of them.
Now, when you say on the rental, does that mean using the rental property yourself?
No, it's doing work for it.
Okay.
Lining up and booking the renters.
I understand. Okay.
Going out and getting supplies, those kind of things. Those are all going to qualify. The IRS does scrutinize this a little bit. If you're just doing things that are considered more of an investor activity, like you're just monitoring your profit and loss for the month and kind of looking over the financials, they consider those to be investor activities and not meeting the 100 hours test. But if you're doing any sort of work or maintenance on the property, if you're booking the renters, if you're kind of lining up all the supplies and stuff, if you're helping renters answer questions, that kind of stuff, those are all activities that count towards the 100 hours. So it's still a decent hurdle, 100 hours during the year, but it's a lot more reasonable than the 500-hour test.
Yeah, sure.
And if you meet this test, the 100-hour test or the 500, and you have the 7 days or less, now's where the major tax breaks kick in. Because now all those losses on the property that we talked about earlier, where under the passive rules you're limited and they carry forward into a bucket, those can actually instead, when you meet these tests, be used against current active income. So the example I usually have, and what I've had with my clients, is the clients that are working here in the Bay Area, they have, W-2 income or other investment income, a few $100,000 or something maybe, and we have a $30,000 loss on the rental just because you're taking that non-cash depreciation deduction and kind of all the other expenses involved in maintaining a rental. You can use those net losses against your active income and you could save big bucks. If you have a $30,000 loss, if you're in the 30% tax bracket, you're going to save 10 grand that year in taxes.
Well, that's huge.
Yeah, each year, right? So we kind of look at it as a way to help offset the cost of owning the home,
Sure.
by renting it out a little bit. Not only do you get the rental income, you also can deduct some of these expenses, especially the operating ones like the insurance, the maintenance, that kind of stuff that you wouldn't ordinarily get to deduct. Now they're deductions. So the effective cost of ownership's a little bit lower.
Now, so we're talking about you actually working on the property, but as the owner of the property, what happens? Are there limitations or are there stipulations in the tax code that say you're using it too much, you're using it personally for the wrong reasons? Help us with the personal use of the vacation home, please.
Yeah, personal use is a area the IRS is going to focus on. They don't want you using the property all the time personally, renting it out a little bit, and then taking massive tax deductions, right? So they have a kind of general rule where if you can use it up to 14 days a year or 10% of the number of days rented, whichever is higher. And if you use that, there's not much of a penalty to the personal use. You don't get kicked out of these special tax rules by using it that much personally. You will lose kind of a pro rata portion of the expenses based on your personal use. But if it's relatively low compared to the total expenses, you're still getting the bulk of the expenses as a deduction, and you're able to take advantage of all the special rules. If you use it more than the 14 days or 10% of the days rented, that's fine. You're just not going to get any of the losses. They're going to be disallowed, and you're only going to be able to wipe the income down to zero, the rental income. You can't just go below zero. But there's a couple, how the code defines personal use is another thing that you need to look at, right?
Okay.
Because, we think personal use, you go up there, you kind of go vacation at the property, right? You go to Tahoe, you go skiing for the day. But the IRS says if you have a work day on the property, it's not considered personal use. So if you can structure your visits that you spend, a day maybe on the front and back end of the visit, kind of doing maintenance on the house, maybe doing a little painting or whatever kind of work is required, you got to be able to substantiate a, 8-hour day basically of work or pretty close, 6 to 8 hour day. If you can do that, a work day is not considered a personal day. So, if you can turn part of your trip up there into some work and still have fun, in the evening, that kind of thing, then you're able to convert a personal day into a work day. That's not going to count towards your personal use limitation. So again, that's where kind of documentation is key. You got to make sure you have a log of all the work you did and on the day you did to kind of back it up. Because when the IRS audits you, they're going to want to see how much is your personal use, how much did you rent it, and if you're going to claim any days that you were there were work days and not personal, you got to kind of run through what you were doing and why it's a work day.
Gotcha. Well, what about if my friends want to go up and in my family? How does that qualify, and where does that fall? What category does that fall into?
Family and friends using your vacation property are totally fine, but they have to pay a fair market rent. If you're going to let your friends and family use the property without paying anything, then that's going to be considered a personal use day. Again, the IRS doesn't want you kind of skirting the rules by just having all your, friends and family use the property all the time personally and taking these big tax deductions. So having your friends and family pay a fair market rent to you will treat them as a normal renter, and then you don't have to worry about those being counted as personal days. If you're not going to charge them, which a lot of us aren't going to do that, that's fine, but they're going to count towards your 14 days a year or 10% of the days rented test.
Okay. Well, now, I've been to some charity auctions before, Matt, and it seems that a lot of people are donating their vacation homes, especially in prime areas like Tahoe. What happens with that?
The saying, no good deed goes unpunished. This is one of those situations, right?
All right.
We got a lot of those clients where they attend the charity auctions. Their kid goes to the private high school, and the high school has an auction. They want to put up their, Hawaii rental or their Tahoe rental as an auction. I'm thinking, hey, maybe I can get some tax benefit from this. I'm kind of doing good and raising money for the charity or the school or whatnot. That all sounds great. The problem is the IRS is going to say that when you donate the use of the property, like at a charity auction, and the person that's using it doesn't pay you anything for it, so they're paying less than fair market value, it's considered personal use days again. The rule really just says that anything less than fair market value is considered a personal day. So that's how you're going to get caught in that trap, even though, like I said, no good deed goes unpunished, right?
Sure. Huh. That's kind of brutal.
Yeah, like I tell my clients, I don't make the rules, unfortunately, but
Not yet, though, right, Matt? We'll
not
work on
yet.
that.
Yeah.
All right. Well, one of the big consistencies that we've had so far in today's podcast is making sure you keep really, really good books and records. And, as a CPA, I know that books and records are something that you personally excel at and your firm does too. What sort of things, and if people are taking notes, which by the way, they should be if this applies to them, let's break down some of the things that you want to share with them about keeping really good books and records.
So one thing you really have to keep in mind with these rules is the tax deductions each year. If you're following the rules and getting those losses against your other income, they can be pretty significant, right? If you're buying a seven-figure home in Tahoe, which is not uncommon, your depreciation write-off every year alone is going to be like in the mid $30,000 to $40,000 a year range for just the depreciation part. Plus, you're going to have the cost of property taxes, all the utilities, the whole everything, right? So you're going to, generally speaking, generate some decent losses with these properties that are tax losses. So if you have a $40,000 or $50,000 a year tax loss when all is said and done, and you're using that against your other income, you're saving over five figures in taxes, $10,000 to $20,000 sometimes in tax every year. So the IRS is going to see that and it's going to kind of stick out. This is one of those red flag things. So when you have a vacation home and you're following these rules, you have to be prepared for an exam if it's going to come. And having detailed books and records is so important in this regard. If you come into an audit where you planned very well and you're very neat and clean on your books and records, everything matches and ties out, you have a much better chance of coming through the audit unscathed than getting a no change, which is the best case scenario in an audit. So a couple of things we talked about that you have to have in there. You got to have the average period of use, 7 days or less, rule in there. Like I said, it's black or white. You want to have a good record of who was renting, how long they rented for, that kind of stuff. And that's going to apply every single year. The next thing the IRS is going to ask for is the personal use days. So you got to have a good record of your personal use days and try to classify as many as work days as we possibly can, right, to minimize the number of personal use days. The other test they're going to look at is that second hurdle, that material participation standards, where you got to spend 500 hours or 100 hours and more than anybody else. So you got to have a log, all the hours you spent on the property, all the hours you spent lining up renters, all the hours you spent doing maintenance, all the hours you spent communicating with renters and doing contracts and, giving them information on the area and buying supplies, all that kind of stuff. All that's going to count. If you have a property management company or something in the activity, you're going to have a little bit harder time meeting the 100 hours and more than anybody else rule. It's possible, but if they're doing a lot of the work for you, it's going to eat into your 100 hours probably because they're doing some of the work there, right?
Well, can I pause you there? I want to ask you a question about the management company. So I do hire a management company. Am I able to write off the fees for the management company? I mean, there's got to be a benefit in outsourcing that instead of, let's say your property, you live in the Bay Area and your property's in Florida. You're not going to be spending 100 or 500 hours out there futzing with a place every year probably. So you hire somebody. Are you penalized for that, or can that be used as a benefit?
You can write off the expense. So any expense associated with your rental is going to be a write-off. But if you're not meeting the 100 hours rule, then it's going to be just part of the passive loss regime when you're going to probably be carrying those losses forward to a future year. So you're still getting benefit there. Okay. Where you're saving up your losses for future years. You're just not getting the current year big benefit we're talking about by meeting the 100 hours rule.
Gotcha. Okay. What else? What else do we need to be making sure that we keep track of?
Another important one is good books and records when you do major improvements or a remodel. If you don't really break out those costs very well, we generally will capitalize those expenses. So we don't get to currently deduct them. We have to add them to the cost of the home, basically, the income tax basis. And we could then depreciate those expenses over the 27 and a half years we talked about earlier. But if you're able to break out those improvements into different components, let's say really, some was related to certain furniture or fixtures, or a new bathtub or sink or some of those kind of things, or some was actually repairs and not necessarily an improvement, then we can turn those into current deductions. Or if there's something we capitalize like a sink or something, we can at least do it over a shorter depreciable life less than the 27.5 years, so we can recover that cost a little faster. So keeping good records, kind of with the breakdown of improvements and everything, can be helpful, and that's really true for any rental property.
Okay.
But it's going to apply to this as well.
So if you have a vacation home, a second home, or a rental property, let's go back through these really quick and just take us on the 30,000-foot view past today's podcast and remind people of really what the rules are, who applies, how those apply, so that people can go ahead and tighten up their notes if they've been taking them.
Yeah, if you have a second property, the 30,000-foot level, you have the regular rental rules where you get taxes and interest, basically. You have the rental rules where now you can deduct all the costs associated with it, but you may be limited in the current year and have to carry them forward. Then you have the short-term rental rules where you get to maybe take all the expenses currently against your other active income. In each case, books and records are key, but as you kind of go down that continuum of the different levels there, the books and records are going to be most important at the 7 days or less, the short-term rental rules, because there's when we get the current tax benefit, and the rules that we went through are pretty specific from the IRS on what you need to do to qualify there to get those tax benefits. But if you do meet those tests, you can turn what otherwise is a second home, source of expenditure every year into something that you're at least getting some more tax benefit from. And that's what we call them lifestyle deductions, because they're part of your current lifestyle. They're probably part of your long-term plan. And this is something that when we're doing a long-term plan with clients, we'll look for these lifestyle deductions. We'll say, hey, you have this second home in Tahoe. Have you ever thought about renting it out? Mm-hmm. Here are the vacation home rules. You may be able to get a little more benefit by doing a little extra work here and really decreasing your cost of ownership on the home, or helping offset it at least by saving a lot in taxes. This is also going to apply, which we didn't cover actually, to like an Airbnb host type situation where you're renting a room.
Yeah, I was going to ask that. That's I'm glad that you brought that up. So can you take a minute and explain how like a Airbnb or something like that applies to the situation?
It's generally going to be the same rules, but you have a higher likelihood of meeting that 7 days or less and the 100 hours, right? There's a couple other, we said there's 7 tests to meet the material participation standards. Mm-hmm. Some of them revolve around providing significant personal services in association with the hours spent on the activity. Those are really meant to apply to like the bed and breakfast type situations. And an Airbnb is essentially a bed and breakfast type situation, mm-hmm. right? More or less. You're almost more like a hotel proprietor or something when you have an Airbnb. So You're certainly going to qualify under these rules if you almost certainly, right? 7 days or less is going to be your usual Airbnb rental. Mm-hmm. You're probably going to have no problem meet the 100 hours because you live there, right? Generally speaking. Or if you have one that's close by, you're doing the Airbnb, you're probably doing a lot of the work. So these rules are going to apply to you, and you're going to be able to get some tax benefit.
So I'm going to throw you a Louie here just because you triggered something in my brain. I was watching one of those real estate shows, and there were some people in your area, in the Bay Area, who are looking to buy a vacation property in a non-U.S. area. What the heck do you do with that? I mean, how does U.S. tax code apply to international properties? Now, this could be a major digression, and I understand I'm really kind of putting you on the spot here, but can you at least give us a 30,000-foot view if people want to buy something in Bali or something? How does that apply to their taxes in the States? Does it at all or no?
Yeah, I mean, the U.S. taxes worldwide income. So if you just own the property outright, like you don't put another entity shielded between you or something in the property, you're going to have the same basic rules. There are a few changes. The 27.5-year depreciable life we talked about, that's 40 years with the foreign property. But generally speaking, it's going to look the same on your tax return. It's going to go on the Schedule E as a rental, and all the same rules are going to apply. But what you'll see more often for legal reasons, especially like local legal reasons, some countries even require it, is you have to own the property through some sort of entity. A lot of countries will limit the ability of a non-citizen to own property.
Yeah.
Mexico is one of these. Until recently, they're kind of changing the rules, but everyone had to own it through a special Mexican trust, set up by an attorney down in Mexico. And really, it's like the bank. You have to find a bank that's a trustee of it and everything. So you kind of have this like shield between you and the property, and that gets into all the international tax rules. And there's more disclosures. And if some of the types of entities that you form will basically form a barrier between you and the property from a tax perspective. So it won't even show up on your personal return anymore, but you'll have a whole different set of issues that you're kind of showing.
Okay. And that's something that that your firm, do you guys handle that in-house, or do you have key people that you refer to?
We refer out the legal work. We obviously don't do legal work here. We're CPAs, but we'll certainly handle the U.S. tax side of all that, all the foreign reporting and disclosure, that kind of stuff. There's pretty stiff penalties for not following some of that kind of stuff. It's not extremely difficult, but you got to make sure you know all the rules and you're following them. Otherwise, you're going to get potentially slapped with some pretty big penalties. They're kind of draconian, 10 grand per violation just for like not putting stuff on a form. I mean,
ouch.
You don't want to be that person. And that's where, if you have something international, TurboTax isn't helping you on this part. You really need to talk to someone who's knowledgeable in the international stuff, so you don't subject yourself to some of those penalties.
Well, and keeping good books and records, as you had said, I mean, that obviously applies here too. Okay, so if you do have a vacation rental home, and you heard the podcast, Matt, what is the best way for them to get in touch with you and reach out and make an appointment and chat with you about these different solutions?
You should really go to our website, wheelercpa.com. We have a white paper we put out on this topic, which you can take a look, and you can actually go through some exercises and see what your current expenses are and how much that would actually generate in tax savings if you were following the rules, which I think is a little helpful tool that they can use. And there's an Ask Wheeler, section of the page where you can, get in contact with one of our folks here who can help you guide through all the more nuanced portions of the rules and that kind of stuff. Oh,
I love the Ask Wheeler thing. That's fantastic. And please take advantage of that, everybody. It's not often that you have, somebody like Matt and his team at Wheeler Accounting have the opportunity to really pick their brains on this stuff. So any closing remarks, anything that we need to cover before we're done?
Yeah, I think that's basically it. I'm going to kind of go back to the thing that we talk about a lot here, which is you got to have a long-term tax plan and strategy, and looking at some of these things, these lifestyle deductions like vacation home breaks can really make a long-term impact on your tax strategy.
Well, that's fantastic. Long-term tax planning is something that is a specialty of Wheeler Accounting. And if you haven't had somebody take a look at something from that long perspective, then you're really going to miss out on a lot of things that could end up saving you a substantial amount of money. So this is Matt Halloran for Debit This, Credit That, joined by Matt Wheeler, the managing partner of Wheeler Accounting, and he's also a CPA. Thanks, Matt, for your time today.
Thanks, Matt.
And I hope you all have a magnificent day.